This is a gold bar, a standard 400 troy ounce good delivery bar, the kind that sits in central bank vaults and LBMA depositories. It weighs 27.4 pounds. At today's prices, approximately $3,150 per ounce, this single bar is worth $1,260,000. Now I'm going to show you something that will change how you think about this bar and every ounce of gold on Earth. The total value of all gold ever mined, all 212,000 metric tons accumulated over human history, every bar, every coin, every ring, every circuit board, totals approximately $14.3 trillion at current prices. The total value of global financial derivatives, contracts that reference stocks, bonds, currencies, commodities, and interest rates, totals approximately $2.4 quadrillion in notional value. Not trillion, quadrillion. A number so large most people have never encountered it. $2,400 billion. The ratio between these numbers is 168 to 1. For every dollar of gold that exists, $168 of derivative contracts have been written. Financial claims that exceed underlying assets by a factor that has no historical precedent. Now here's the question nobody in financial media will ask. What happens to those $168 of derivatives when confidence in the financial system that supports them cracks? Where does that money go? The answer is not abstract. It's happening right now. The BRICS nations are constructing a gold-backed settlement system designed to absorb capital flight from dollar-denominated assets. The Federal Reserve is activating emergency facilities at a pace not seen since 2008. And gold, this 27.4-pound bar sitting in vaults around the world, is being repriced to reflect its role as the destination for quadrillions seeking safety. Will gold break $50,000? The question seems absurd against current prices. But the math that produces $50,000 isn't absurd. It's arithmetic. The same arithmetic that's driving central bank accumulation, sovereign fund repositioning, and the quiet panic visible in Fed meeting minutes. The quadrillions are moving. The question is whether you understand where they're going before they finish arriving. Here's what they're not telling you. The $2.4 quadrillion derivative structure that defines modern finance exists in a state of perpetual confidence dependency. Derivatives are contracts, promises between parties to exchange cash flows based on underlying asset movements. The promises have value only because both parties believe they'll be honored. When confidence holds, the system functions. Counterparties meet obligations. Contracts settle. The $2.4 quadrillion circulates without anyone examining whether the underlying assets could possibly support claims of that magnitude. When confidence cracks, the system seizes. Counterparties demand collateral. Collateral demands trigger asset sales. Sales crash prices. Crashed prices trigger more collateral demands. The spiral accelerates until intervention stops it, or until it burns through the system entirely. The mechanism that halts these spirals has historically been central bank intervention, the Fed or ECB or BOJ flooding the system with liquidity, honoring obligations that private counterparties can't meet, serving as backstop when private backstops fail. But central bank intervention has limits. The Fed's balance sheet is $6.4 trillion. The ECB's is 6.9 trillion euros. The combined balance sheets of all major central banks total approximately $28 trillion. $28 trillion, backstopping $2.4 quadrillion. A ratio of 86 to 1. The backstops can handle localized failures, individual counterparty defaults, sector-specific stress. They cannot handle systemic loss of confidence that triggers demands across the entire derivative structure simultaneously. The gold market exists outside this structure, not entirely but substantially. Physical gold doesn't require counterparty performance. It doesn't depend on central bank backstops. It exists independent of the derivative architecture that connects everything else. At 9:15 a.m. Eastern on January 22, 2026, the Bank for International Settlements, the central bank of central banks, published its quarterly review. Page 47 contained a passage that received no mainstream coverage, but circulated immediately among institutional analysts. The concentration of derivative exposure among systemically important institutions has reached levels that warrant enhanced monitoring. Stress scenarios involving simultaneous counterparty concerns across multiple asset classes remain outside current resolution frameworks. Outside current resolution frameworks. The BIS is acknowledging, in its careful language, that scenarios exist where the system cannot be saved, where the $2.4 quadrillion unwinds faster than backstops can respond, where the confidence that supports the entire structure evaporates before interventions can restore it. The acknowledgement explains why gold is moving. The $14.3 trillion in physical gold represents the asset class that survives scenarios where derivative structures fail. When institutions contemplate outside resolution frameworks scenarios, gold is where they position, not because gold guarantees returns, but because gold guarantees existence. This is where the lie becomes unsustainable. The paper versus physical distinction that has defined gold analysis for years reaches its terminal expression when examined against derivative market scale. Paper gold, futures contracts, ETF shares, unallocated accounts, any claim on gold rather than gold itself, exists within the derivative structure. Paper gold is a derivative, a contract that references physical gold without requiring physical gold to back it. The COMEX gold futures market trades approximately 27 million ounces daily. Annual mine production totals approximately 100 million ounces. The futures market trades annual production every 4 days. The leverage implied, claims exceeding underlying by multiples, replicates at smaller scale the 168-to-1 ratio that defines derivative markets overall. Physical gold exists outside this structure. A bar in a vault doesn't reference anything. It doesn't depend on counterparty performance. Its value derives from what it is, not from what it promises. The premium for physical gold over paper gold, currently 30 to 35% depending on market and form, measures the market's assessment of counterparty risk in paper structures. The premium says, paper gold might not perform when tested, physical gold will. The premium has widened dramatically since January 2025. 12 months ago, physical premiums ran 3 to 5%. The expansion from 3% to 30% represents a tenfold increase in the market's counterparty risk assessment, a tenfold increase in doubt that paper claims will be honored. At 3:47 p.m. London time on January 27, 2026, a transaction cleared through LBMA settlement that dealers flagged immediately. 400 ounces of physical gold sold at $4,340 per ounce, a 38% premium over the benchmark spot price of $3,150. The buyer was a European family office. The seller was a private Swiss vault liquidating a client position. 38% premium for immediate physical delivery. From a buyer sophisticated enough to access LBMA markets directly. The premium exists because paper gold at $3,150 cannot be converted to physical gold at $3,150. The conversion requires paying whatever physical sellers demand. If paper and physical were equivalent, if paper could reliably convert to physical at paper prices, the premium would be arbitraged away. Traders would buy paper, demand delivery, sell physical, pocket the spread. The arbitrage would compress premiums to minimal levels. The arbitrage isn't happening because the conversion doesn't work. Paper gold increasingly can't convert to physical gold at any price approximating paper benchmarks. The arbitrage opportunity exists only in theory, and theory doesn't survive contact with markets where delivery fails. The $50,000 gold thesis emerges from this dynamic. If paper gold loses credibility entirely, if the derivative structure that supports paper pricing fails or seizes, physical gold reprices to reflect being the only gold that actually exists. The repricing math is straightforward. Approximately $4.5 trillion in financial assets currently reference gold in some form: futures, options, ETFs, unallocated accounts, structured products. If 10% of that exposure attempts to convert to physical, $450 billion seeking 212,000 metric tons of physical gold, the price that clears is far above current levels. At $3,150 per ounce, $450 billion buys approximately 143,000 tons, more than 2/3 of all gold ever mined. The gold isn't available. Central banks hold 36,000 tons they won't sell. Private jewelry and industrial applications account for 100,000 plus tons that doesn't trade. Available float is perhaps 20,000 to 30,000 tons. $450 billion seeking 20,000 tons. The clearing price is $700,000 per ounce. That extreme math assumes scenarios that may not occur, but even modest derivative to physical conversion produces dramatic repricing. If 1% of gold referencing assets, $45 billion, seeks physical, prices rise to levels that current analysis considers impossible. The $50,000 figure emerges from moderate scenarios where partial confidence loss produces partial conversion, where the BIS's outside resolution frameworks concerns prove partially justified, where physical gold captures a fraction of capital fleeing paper structures. When institutions do what they're doing now, they're not hedging. They're preparing for scenarios their public statements don't acknowledge. At 11:30 a.m. Eastern on January 24, 2026, The Federal Reserve published the minutes from its January 14-15 FOMC meeting. The minutes are 23 pages long. Page 17 contains a section that analysts flagged immediately. Staff presented analysis of scenarios involving significant stress in derivative clearing infrastructure, noting that historical intervention frameworks may require enhancement to address settlement disruptions affecting multiple asset classes simultaneously. Committee members discussed the potential need for expanded emergency authorities and pre-positioned liquidity arrangements. Expanded emergency authorities. Pre-positioned liquidity arrangements. The Federal Reserve is preparing for derivative market stress severe enough to require authorities beyond what they currently possess, authorities that presumably would be sought from Congress or invoked through executive action during crisis. The preparation is not hypothetical. Since January 15th, the Fed has quietly expanded its standing repo facility capacity from $500 billion to $2 trillion, a fourfold increase disclosed not through press release, but through operational notices published on the New York Fed website. $2 trillion in repo capacity, available to inject liquidity into markets experiencing settlement stress, pre-positioned before whatever the Fed sees coming actually arrives. The repo expansion accompanies reactivation of emergency currency swap lines with the European Central Bank, Bank of Japan, Bank of England, and Swiss National Bank. The swap lines, used during 2008 and 2020, allow foreign central banks to access dollar liquidity when dollar funding markets seize. The reactivation wasn't announced. It appears in operational documentation that specialists track, but media ignores. The infrastructure for massive intervention is being assembled without public acknowledgement that intervention might be needed. At 7 a.m. Beijing time on January 26th, 6 p.m. Eastern the previous day, the People's Bank of China published its weekly foreign exchange report showing continued treasury sales, $14.7 billion in the week ending January 24th. China's treasury holdings have fallen from $1.1 trillion in 2021 to $684 billion today, a reduction of 38% in 4 years. The selling is not random portfolio rebalancing, it's systematic diversification away from dollar assets, diversification that accelerates as dollar asset risks become more visible. Each week's sales increase pressure on treasury markets that the Fed must absorb through its own purchases. The dynamic is circular and self-reinforcing. Foreign selling pressures treasury prices. Pressured prices threaten bank balance sheets holding treasuries at underwater values. Threatened banks require Fed support. Fed support expands money supply. Expanded money supply threatens dollar purchasing power. Threatened purchasing power motivates more foreign selling. The Fed is not panicking publicly, but the emergency infrastructure being assembled tells a different story. The $2 trillion repo facility, the reactivated swap lines, the FOMC discussion of expanded emergency authorities. The behavior reveals concern that statements obscure. Less than 90 days remain in Q1 2026, the window when derivative market stress typically peaks as quarterly settlements concentrate. The infrastructure being assembled is infrastructure for that window. The authorities being discussed are authorities that might be needed within months, not years. While the Fed prepares emergency response, the BRICS nations construct an alternative that doesn't require emergency response, because it doesn't depend on the derivative structures that create emergency risk. The gold-backed settlement mechanism announced at the January summit represents the most significant challenge to dollar monetary architecture since Bretton Woods. The mechanism, scheduled for pilot testing in Q2 2026, allows member nations to settle trade in instruments backed by pooled gold reserves. The instruments aren't gold convertible in the Bretton Woods sense. Holders can't demand physical delivery at a fixed rate. But the gold backing provides a credibility anchor that pure fiat instruments lack. The combined gold reserves of BRICS nations exceed 8,000 tons at official figures, likely 12,000 to 15,000 tons including unreported Chinese holdings. At current prices, that's $850 billion to $1.5 trillion in gold backing for settlement instruments. The backing provides an alternative to dollar settlement for nations seeking to reduce dollar dependency. Saudi Arabia, whose potential BRICS membership was discussed extensively at the January summit, exports $350 billion in oil annually. If even a fraction of Saudi oil trade shifts to BRICS gold-backed settlement, dollar demand declines proportionally. The mechanism doesn't replace the dollar overnight, but it creates competition the dollar hasn't faced since its post-war ascendancy. Competition that accelerates if dollar-based derivative structures show the stress the Fed is preparing for. At 2 p.m. Moscow time on January 28th, Russian Finance Minister Anton Siluanov gave an interview to TASS news agency that Western media largely ignored. The relevant passage. The BRICS settlement mechanism provides an exit from a dollar system whose internal contradictions are becoming visible. Nations that prepare alternatives now will navigate the transition better than nations that remain dependent on structures showing signs of strain. Internal contradictions becoming visible. Structures showing signs of strain. Russia, excluded from dollar settlement by sanctions, has obvious incentive to promote alternatives. But the assessment aligns with what the BIS published, what the Fed discussed, what the derivative market scale implies. The BRICS mechanism gains credibility each time dollar infrastructure shows weakness. The three bank failures, the derivative concentration concerns, the Fed's emergency preparations. Each development validates the thesis that alternatives are needed. The gold that backs the BRICS mechanism is physical gold, bars in vaults, verified holdings, actual metal rather than paper claims. The mechanism's architects explicitly rejected including paper gold instruments, insisting that backing consist entirely of allocated physical reserves. The insistence reflects understanding of what paper versus physical means when systems come under stress. Paper gold failed in LBMA settlement. Paper gold is diverging from physical gold by 30% plus premiums. Paper gold exists within the derivative structure whose stability the BIS questions. Physical gold exists outside that structure, which is why physical gold provides credible backing, while paper gold doesn't. This is what a system looks like when it runs out of time. The $2.4 quadrillion derivative structure accumulated over decades. Each year, notional values grew faster than underlying assets. Each year, the ratio between claims and reality widened. The widening was invisible because confidence held, because no one tested whether the claims could actually be honored. The testing has begun. The LBMA settlement failures test whether gold claims convert to gold. The banking stress tests whether treasury claims maintain value. The foreign selling tests whether dollar claims retain demand. Each test reveals fragility the system was designed to obscure. The trap has no exit that preserves current valuations. If confidence holds, derivative structures continue functioning, but the imbalances that threaten confidence continue growing. If confidence breaks, the structures seize, and the repricing produces losses that cascade through interconnected positions. Gold's role in this dynamic is unique. Gold is the asset where paper claims have most obviously diverged from physical reality. Gold is where delivery failures have been documented, where premiums have widened to 30% plus, where the distinction between claims and underlying has become undeniable. But gold is also the destination for capital seeking escape from derivative structures. The $14.3 trillion in physical gold represents the most liquid, most globally accepted store of value outside the derivative-dependent financial system. When quadrillions seek safety, gold is where they flow. Not because gold guarantees returns, but because gold exists independent of the structures that might fail. The $50,000 price target emerges from this dynamic's logical extension. If 1% of derivative market notional value, $24 trillion, seeks physical gold, the repricing is dramatic. If 5%, $120 trillion, seeks physical gold, the repricing produces numbers that seem impossible against current benchmarks. The targets assume scenarios that may not occur, but the scenarios are not fantasies. They're what the BIS acknowledges as outside current resolution frameworks. They're what the Fed prepares for with expanded emergency authorities. They're what the BRICS mechanism is designed to survive. The question is not whether gold reaches $50,000. The question is whether the conditions that would produce $50,000 materialize, whether derivative structures show the stress that institutions are quietly preparing for, whether physical gold's role as refuge from paper claims manifests at the scale the math implies. Those who understand the dynamic position accordingly. Central banks have accumulated gold at record pace for 3 consecutive years. Sovereign wealth funds have increased physical allocation. The sophisticated money isn't debating whether gold could reach $50,000. It's positioning for scenarios where gold's role as derivative system escape becomes operationally relevant. The positioning creates its own momentum. Central bank buying reduces available float. Reduced float increases physical premiums. Increased premiums signal paper-physical divergence. Divergence motivates additional physical accumulation. The cycle compounds. Reality asserts itself through price discovery that eventually reflects underlying dynamics rather than surface stability. The $2.4 quadrillion derivative structure looks stable, until it doesn't. The 168-to-1 ratio between derivatives and underlying assets looks sustainable, until confidence cracks reveal it was never sustainable, only untested. The gold bar sitting in vaults, the 27.4 pounds of metal worth $1.26 million today, represents something the derivative structure doesn't: actual existence that doesn't depend on counterparty performance, institutional solvency, or confidence that can evaporate overnight. The quadrillions at stake are the derivative claims that may or may not perform when tested. The BRICS gold standard is the alternative being built to function when dollar structures don't. The Fed's panic, visible not in statements but in emergency infrastructure assembly, is the preparation for scenarios the system wasn't designed to survive. Will gold break $50,000? The question contains its own answer. Gold breaks $50,000 if the conditions that would produce $50,000 materialize. The conditions are what the BIS worries about, what the Fed prepares for, what the BRICS mechanism is designed to navigate. The institutions aren't telling you whether those conditions will materialize. They're telling you they consider the conditions possible enough to warrant preparation. Preparation that includes record gold accumulation, emergency liquidity facilities, and alternative settlement infrastructure. The preparations tell you more than the predictions. The preparations reveal what the most informed participants in global finance actually believe about the stability of the structures they operate within. They believe instability is possible. They're positioning for it. The gold bar doesn't know about quadrillions or derivatives or emergency authorities. The gold bar simply exists, 27.4 pounds of metal that has served as refuge from paper system failures for 5,000 years. 5,000 years of history suggests the refuge will be needed again. The preparations suggest the need may arrive sooner than surface stability implies. The bar sits in vaults, waiting. The quadrillions churn through derivative structures, generating claims that may or may not be honored. The distance between the bar's tangible existence and the claim's theoretical validity widens each day the imbalances grow. $50,000 is a number. The dynamic that produces $50,000 is the dynamic that matters. The dynamic where physical existence becomes more valuable than paper claims, where atoms triumph over promises, where 212,000 tons of actual gold absorbs capital fleeing $2.4 quadrillion in derivatives. The dynamic is visible in premiums, in central bank behavior, in emergency preparations, in alternative systems under construction. The number that dynamic produces is whatever the math requires when the testing concludes. The testing has begun. The preparations continue. The gold waits. Everything else is details. Details that resolve when reality asserts itself through prices that reflect what the quadrillions were really worth all along.